Here we are. Hi, it's Jessica from Porchlight Real Estate Group. I'm really excited today because I have Megan Aller with me. And if you are in Colorado and you're in real estate, then you already know who Megan Aller is. Because if you survived through the stay-home order, you probably listened to Megan.
Nothing better to do, right?
Well, I mean, you kept us like hopeful and educated about what was going on. So if you're not a real estate agent and you're one of my clients or followers or friends, I'll introduce you to Megan. Megan's with First American Title, and she is just a spreadsheet, graph, and data wizard. I don't know what other title you would like to have. But so over the stay home COVID time, since March, right, Megan, you've been doing weekly updates. So
yeah, yep. It's been since I think it's the last week in March. It's when it all started.
Yep. So since March, Megan's been doing a weekly update for us, giving us just a huge amount of data of what the market's doing, what we can expect, what's surprising, what's happened in the last week, what her predictions are. It's been very valuable during that time, just seeing what's happening, but especially coming out of that time as far as giving our buyers and sellers actual data of what's happening in the market. So today we're going to focus more on the buyers, and I would love to have Megan back next time, and we'll talk more to people who are either currently or plan to have their homes listed. But today I really want to talk about buyers, and specifically, I know buyers are hearing so much about interest rates. I mean, we all are. You can't really exist without hearing about interest rates right now. And there's just not a whole lot of education or understanding about what that means. I think a lot of times a buyer thinks that means, oh, that's great, my payment might be lower. And while that is true, the whole idea of what's buying power is what I want Megan to share with us today, of how your money can actually go further. So I will turn it over to you, Megan, to talk about that.
Awesome. And you can see my screen, right?
Not yet. Hold on.
Not yet.
Setting here.
Okay. So let's see. Share screen. Here we go.
Oops.
Just to be sure. Did I do it on my side? We're good?
That's weird. I see us twice now. Hold on.
Yeah. So here's what I'm going to do. If I go this way, then this should work.
Yep.
Better?
That's perfect. Yep.
Okay, awesome. So when I talk to consumers, oftentimes I kind of have this, well, number one, let me start out this way. Oftentimes, if I'm eating lunch alone, it's the few and far between time that I get some quiet time in my house. When I eat lunch alone, and especially prior to COVID, when I was going out to restaurants, if I'm by myself, I always have this uncanny ability to sit next to people who are talking about real estate at a table next to me. And so I just have to forewarn you, if you sit next to me and you see that I'm alone, I might have earbuds in, but I'm actually eavesdropping on absolutely everything you say. And I know that your conversation at some point is going to turn to talking about real estate. And I've heard this statement come up in nearly every single conversation that I've eavesdropped on, and especially with younger buyers that say, gosh, I would love to buy a house. Home prices have gone up too fast. I don't think it's affordable, so I'm going to wait for the market to crash to make a purchase. And what I wanted to talk about is affordability. And when we look back at historical data here in Metro Denver, it's very true that home prices have gone up pretty drastically. And so, of course, I have a graph to show you that. It's this guy in the middle with the red line. And since 2009, when we really bottomed out in our market, we've gone from $238,000 for an average sales price up by almost $300,000 in that 11-year time frame, and our current average price is now $534,000. Now, while it's true that home prices have gone up, the other cost that most consumers aren't factoring in is the cost of the money that they have to borrow. And as of last year, through the end of 2019, it ends up being about 90% of consumers require some sort of financing to get into a house. And the other thing that kind of couples with this is when I hear buyers say, I'm going to wait for the market to crash, what's more likely to happen, since we've had such a very strong market, that interest rates will go up in the future by the time that we would see any of that offset by a potential fall in our market. At a minimum, that's probably 1.5 to 2 years out, if that happens. Again, it's highly unlikely. What's more likely to happen is your interest rate's going to go up. And your interest rate actually has a more significant impact on your purchasing power than just the price alone. And so rather than waiting for the market to crash, what you should consider is purchasing while interest rates are low. When interest rates drop to where they have as of now, at the end of May, we were looking at about 3.25, and there are days where it drops below that. In those times where it drops below that value, what happens is it actually increases your overall purchasing power. And this year is kind of like that Goldilocks zone. While we've had a couple of hits in the marketplace due to appreciation not taking off during the months that it typically builds in, as of right now, home prices are actually down by about 2.5% year over year. That number is likely to climb in the next couple of months, but you have a really nice opportunity because based on the information from last year, our interest rates are actually down by 0.75 of a point. And when we do the funny finance math to work it out and figure out what your mortgage payment looks like for principal and interest payments, year over year, that means that your P&I payments, even though home prices only went down by 2.5%, your principal and interest payment went down by 11%. And so that's a really huge jump in your affordability. And even when we just started out at the beginning of this year, there's a little table over here on the right-hand side that we're going to look at. Here's the visual representation, so you see how that can change. But at the beginning of the year, we started out with an average price in January of about $500,000, and our interest rates were 3.5. Now, when interest rates drop down to 3.25, you don't, your principal and interest payments remain the same, but what happens is your overall purchasing power actually increased by 3%. And so just that little tiny 0.25 point interest rate drop yielded 3% more purchasing power. And if you're able to buy down your rate and lock in at 3%, that means that you've increased your purchasing power by 6%. And so these extremely low interest rates actually have a huge impact. Now, just like that, when it drops, it can also work against you. And what happens is interest rates go up, keeping with that same principal and interest payment here to buy a $500,000 house, that $2,245 for your principal and interest payments each month. What happens if rates go up to 4%? You lose $30,000 worth of purchasing power based on that 3.5% interest rate. And what happens if they go up to 4.25, which isn't that too far off? That means that you've lost nearly $50,000 or 10% of your overall purchasing power. And so the value of low interest rates actually has a huge impact on what you're able to purchase within the marketplace. And so what I would encourage you to do is take advantage of these low rates. If you choose to wait to see if there's going to be a drop in the market, A, it's unlikely, but B, you might be shooting yourself in the foot because it's more likely that interest rates are going to end up going up.
I get that question so often and you explain it so much better. Or I get the statement, like you just said, I'm going to wait for the market's going to crash and I'm going to wait for that to happen and then I'll buy. So I don't know if you know the answer to this, but I'm going to guess you do. Let's take a $500,000 house. What would the equivalent market crash be? How much loss would that house have to show in order to be comparable to, let's take 0.25% or 0.5% interest rate?
Sure. I actually don't know that off the top of my head. I think you stumped me right on camera. And so, if home prices were to fall by 10%, in theory, that would offset. But again, it's unlikely that we're going to see that 10% decline.
I mean, when was the last time we had a 10% decline in this market?
So we did see that happen back in 2008 when we went into the Great Recession. But the relationship between supply and demand is in large part what determines what happens with home values. And at that point in the market, to cause that much of a drop in our prices, it required us to have a 10-month supply of inventory. And as of right now, we're sitting at less than 1 month of inventory. So ways that we can talk about this number are, at the given rate of sales, how long would it take in time to sell off the current amount of inventory if no new units came into the market? And so that meant that back in 2008, headed into the Great Recession, for every one buyer in the market, they had 10 homes to choose from. right now we're literally putting more units under contract than we have to sell. And so in the market conditions that we're in currently, there's typically multiple offers. And so it's not just you that's looking at a house. You have less than one choice that's available, especially if you're looking at homes that are under $500,000. And so that doesn't mean that you team up with another buyer and you go halfsies on purchasing the house. It means that you're in multiple offers, and that's what's driving prices back up. Now, we've got a bit of a lag in our appreciation this year due to the events of COVID. Now that we've come out of it and we're in our rebound portion of the marketplace, we have an absolute buyer surge that's happening right now. So it's still worth it to try and go out there and be in competitive offers while your purchasing power is at a maximum. Because if rates go up and we still maintain the same relationship between supply and demand, your purchasing power goes down and it's more difficult for you to be a competitor in this marketplace.
Right. Yeah, it is a very competitive, especially like you said, in the under 500, multiple offers, really competitive offers. Yeah, it's definitely not a seller's marketplace. It's a buyer's market when you're under the 500.
Definitely.
Buyers.
It's wild. It's wild out there right now.
What else do you want to share, Megan, as far as what's happened in the last week or so that is of interest to our buyers?
So since we ended up having the end of March, April, and the beginning of May more or less zapped off the face of the earth, where it was really challenging for us to work in the marketplace, we've had a lot of buyer resiliency, and that was kind of an unknown factor. We know that there's been a lot of unemployment, salary reductions, furloughs, unemployment is at its highest levels. And we were really concerned to see what buyer resiliency looked like. And so I've been tracking showings very closely. And watching these showings, it's definitely obvious that we have a surge of buyer activity right now. And with that surge of buyer activity, the next question is, how long does this last? And so, there's a lot of unknown factors that can happen over time. We don't know if there's going to be a resurgence of COVID. We're not quite sure what's going to happen with kids going back to school yet or not next year. And so when it comes to how long can this market last, there's basically two different options. One is that we either extend our selling season. Typically, our selling season ends the week after July 4th, where we transition into a market where buyers tend to have more negotiating power. The other option is that we double time and we get caught back up. And what it feels like right now is that we are doing double time. And when I track the number of contracts that have been written and accepted year to date, we're only behind by about 2.5% year to date, even in light of losing nearly 6 to 8 weeks of our lives being in quarantine through COVID. And so I think that if you're a seller in this market, it would behoove you to put your home on the market sooner rather than later so that you can take advantage of this surge of buyer activity that we're experiencing right now.
I would agree with that. Yeah, it's wild out there showing houses.
Did you show this last weekend?
I've been showing pretty nonstop. I have a ton of buyers and a lot of first-time home buyers, and it's just been very, very competitive.
Definitely. Well, and I still think that it's worth the battle. This is when the majority of new listings are coming on market. And with homes that had chosen to withdraw or hold until listing until after COVID, or we had more clarity on what the market looked like, you have more choices right now, but they're coming on the market so quickly and going under that you have to be quick to go out there and look
very
at
quick.
those.
You got to be like day one.
Yeah, definitely.
You have to have a real estate agent. Let's just be really clear on that.
Yes.
You can't be going to open houses because there are none, and it's so competitive.
Definitely.
Yeah, so competitive. Well, thank you so much for your time. I would love to have you back. I know your time is precious, and I appreciate you so much and your wisdom and your number crunching. I think it's so valuable to us.
Of course. My pleasure. Anytime.
Thanks, Megan.
See you later.
Have a great rest of your day.